Good morning, everyone, and welcome to the Daily Trader with Kevin Hincks. I'll be taking you through two paper money trades today on two high-profile names. We'll look at Palantir, which seems to be recovering off its recent sell-off, and then we'll look at Google Alphabet, and probably the cheapest valuation of the Magnificent Seven names. So let's get right to it. I have a different type of trade that I'm going to show you today in both these instances that focuses on a lack of vega, and I'll show you why. So first, let's get to Palantir, our trade. We looked at, if you look at the chart, Palantir has been down 27.8% in the last month. Now, the stock had a historic run. Before that, 6 months, it's up 133%. So this stock has traded all over the board. So one way, because something I've talked about in the last couple of podcasts is vega exposure. If implied volatility starts to come down, here's a way to minimize vega exposure, and that is a bullish trade with limited vega exposure. It's called the unbalanced butterfly. So what I did, I went out to March 28th, and that is 16 days from now, and I bought the 85 call. So basically the at the money, or just slightly out of the money call now in Palantir. Bought the 85 call, sold two of the 95 calls, and then to finish the butterfly and make it unbalanced, I bought one of the 100 calls. So a $10 call vertical and short a $5 call vertical. 85, 95, 100. If you see that on the risk profile there, it goes up because you're looking, like any butterfly, you're looking for a move towards those short strikes of $95. However, if it were to go through that, right, a normal equidistant butterfly loses all its profits. This one would hold on to some of them as you're long a $10 call vertical, short a $5 call vertical. So it's an unbalanced butterfly. It gives you about between 15.5 and 16 long deltas, but it doesn't give you a lot of vega exposure. It's less than $1 per point in vega exposure. Why? Because all your options are in the same expiration. So it's relatively neutral in terms of vega exposure. Something to think about when you're dealing with high or low implied volatilities, like you are now dealing with very high implied volatility. So Palantir, the risk on the trade, I put it in about 230. It's trading about 210, 215 range right now, so slightly lower than where we put it in. The risk on a butterfly is the debit paid. There's the risk. And it peaks out, like I said, right at or near that short strike of $95. And then on the upside, like I said, you're insulated from losses because you're long a bigger call vertical than you're short. Again, the risk is a downside move, and the debit paid is the risk. Okay, let's get to our second trade, and that is Google Alphabet. Now, Google Alphabet's a similar scenario in terms of the chart. If you look at the last 1 month, down 11%. The Magnificent Seven has been hit more than the overall rest of the market. So again, we're going to look at a similar type trade in Google Alphabet, buying something pretty much right at the money, the 165 call. This time I went out to April 4th, even gave myself a little more duration, going out to April 4th, buying the 165 call, looking at the expected move out to April 4th, it's $13. So a little bigger move. So what can we do to use that move? Well, we did the 165, sold two of the 180 calls, and then bought one of the 185 call. Remember, Palantir was a $10 and then a $5. This is a $15 and then a $5. The debit paid on this is about $4.20, trading a little higher than that as Google has rallied slightly since we put this trade in, trading about 440, 445 range. Again, whatever debit paid is the risk on this trade, and you're looking for a move towards the short strike of $180, in line with the expected move. And in this case, going out to April 4th, you have duration. You have 23 days, 3.5 weeks of duration for this trade. So a move in Google Alphabet towards that 180 strike is the idea for this. It's long about 29 deltas. Remember, it's a $15 call vertical and then a short $5 call vertical. And again, looking for a move towards the 180 strike. However, if it moves towards the 185 strike, your profits come down, but they don't come all the way down. They flatline at a certain level. So these are two trades. Again, very limited amount of Vega on this, all the way out till 3 weeks, and it's $3 in Vega. Not zero, but you're still buying more premium than you're selling, but a very limited amount of Vega exposure in Google Alphabet. So 2 trades, 2 unbalanced butterflies, risk defined in both to the debit paid, and both looking for moves towards the short strike. $95 in Palantir and $180 in Google Alphabet. All right, that's our show for today, everyone. We'll see you tomorrow with another edition of The Daily Trader. I'm Kevin Hincks.